Hello and welcome to CMS Forex News. I'm your market analyst Nick Nassad. Today is Thursday, January 8th, 2009. We begin a busy day of fundamental data in Australia, where the construction sector fell deeper into contraction. The December construction PMI decreased to 30.9, where any level below 50 represents contraction. In another poor release from the housing sector, building approvals fell 12.8% in November, a much larger decrease than forecast. A third release from Australia shows the trade surplus shrinking to 1.45 billion Australian dollars as exports fell by 4% while imports rose 2%. The combination of weaker trade, poor housing, and a slumping construction sector all point to further interest rate cuts by the Reserve Bank of Australia. The Australian dollar and other commodity pairs weakened overnight as oil prices tumbled yesterday by $6 and risk aversion increased. The main stock index in Tokyo was down almost 4% overnight, while Sydney's was down 2.3%. That led to an unwinding of carry trade during the Asian session, extending the slide in the Aussie-Yen pair to 350 pips for the last two sessions. The pair found support just below the 64 level, but only managed a slight counter-rally during the rest of the session. Swiss consumer prices eased more than expected in December, falling 0.5%, following a drop of 0.7% in November. That put the annual inflation rate at 0.7%, more than half the levels seen in November, and down considerably from a peak of 3.1% in July. Prices are falling as a result of lower costs for oil products, though prices for transportation, housing, and energy, and also for clothes and shoes dropped by more than 1% on the month. The unemployment rate in Switzerland, meanwhile, increased in December to 2.8% on a seasonally adjusted basis, and to 3% in unadjusted terms. That puts unemployment at its highest rate in 2 years, and is the first time since 2003 that unemployment is higher at year's end than at the beginning of the year. In Germany, trade data showed that exports plunged 10.6%, a record amount, in November, which slashed the trade surplus by about one-third. The surplus on a seasonally adjusted basis shrank to 10.7 billion euros. The large drop in exports reflects the worsening situation in the global economy, which is seeing a sharp and synchronized downturn of the major economies. Factory orders in Germany reflected that downturn. Orders fell 6%, more than triple what forecasts had called for. It was the third month of declines following drops of 6.3% and 8.3% in the previous 2 months. That slump is the worst since records began after Germany was reunified in 1991, pointing to a weak 2009. Economic conditions continue to deteriorate in the Eurozone as sentiment among consumers and businesses continue to fall. The overall economic sentiment index declined to a record low of 67.1, as all three major groups, consumers, and the services and industry sectors saw significant falls. The business climate index was also significantly lower. The data puts extra pressure on the ECB to lower rates in the face of a worsening economic situation. Another report showed the Eurozone unemployment rate rise to a seasonally adjusted 7.8%. That is the highest in nearly 2 years. Increased joblessness will limit spending by households and further the cycle of worsening economic conditions. The Euro-Yen pair fell 200 pips in overnight trading to test a level around 124. Stocks in Asia were sharply down, fueling part of the risk aversion, as most of the fall in the pair came before the European releases. Today's action broke below support at 125.30, though the pair retested that level in New York trading. The euro also drifted lower against the dollar overnight, but only pairing about one-third of the gains seen in the previous two sessions. The weakness in the dollar continued in New York trading, and the pair hit a new high for the rally at 1.38. Trading is expected to consolidate, though, as traders await tomorrow's non-farm payroll data from the U.S. The Bank of England cut its benchmark interest rate by 50 basis points to 1.5%, as was expected by a consensus of economists. That follows a 100 basis point cut on December 4th. That puts the interest rate at its lowest level since the bank was founded in 1694. Expectations are that the bank will cut rates below 1% by the second quarter, and will have to resort to non-conventional monetary policy techniques such as quantitative easing in order to dig the UK economy out of its recession. The pound-dollar pair has been on a tear recently, with the pair hitting 1.53 yesterday before sliding in the Asian session to 1.4980. Following the Bank of England decision, where some traders perhaps expected a larger cut, the pair surged 300 pips, bringing it to a new high for the week at 1.5370. The euro-pound pair fell further today, with the pair hitting an intraday low of 0.8890 following the Bank of England decision. The pace of the downtrend for this pair has slowed compared to the beginning of the week, and the correction may be imminent. In our last release, jobless claims in the U.S. reported their second week in a row of surprising data, as claims fell by 24,000 to 467,000. However, the number of total people on unemployment rolls climbed to a 26-year high of 4.61 million people. The dollar-yen pair followed up yesterday's drop with another steep fall today, as declines in global equities pressured the greenback. The pair fell from its intraday high at 92.90 to a low of 90.80, a change of 200 pips. That cut down the rise we saw last week by about 76.4%, a key Fibonacci level. Looking at overnight, the steady stream of fundamental news continues. The UK will post data on manufacturing and industrial production and its producer prices. Germany will post its production figures, and along with the Eurozone, will release information on retail sales. Tomorrow, we get the non-farm payroll data from the US, one of the most closely watched releases. Canada releases its employment data as well, along with information on housing starts and building permits. And that wraps up our recap for today. Thank you for joining us here at cmsfx.com, and happy trading.